Welcome to the Goals on Fire podcast, the show where we ignite your path to financial freedom and explore how defining a meaningful life through goals and strong personal values can shape your investing approach and elevate your decision making with money and beyond that. Together with insightful guests, we dive into intersection of purpose, personal finance, and long-term investing to help you live with intention and hopefully invest with more confidence. Today, I'm thrilled to welcome a well-known figure in the evidence-based investing world, Ben Felix. He is a portfolio manager and chief investment officer at PWL Capital. He is CFA and CFP certified, a father of four, and a quite tall, well-built guy. You may know Ben from his YouTube channel, where he breaks down complex financial research into accessible insights, or from the Rational Reminder podcast, where he and his co hosts from PWL Capital have built a community of quite thoughtful investors who value substance over speculation. Uh, we live in the world where, many personas in financial world and YouTubing rely on gut feelings, market predictions, while Ben builds his philosophy on peer-reviewed research, historical data, and the kind of evidence that actually stands up to scrutiny. My audience definitely enjoys these types of truthful analytics and actionable insights, so we're happy to have you here. Ben Felix, welcome to the Goals on Fire podcast. How is the summer in Canada these days?
Hey, thanks for inviting me on. That was a great introduction. Sounds like a very cool podcast as well. Happy to be here. Summer in Canada is beautiful. I live in a very nice part of Canada, with hot summers. It gets a little bit humid. That's the biggest downside. But really nice weather for doing outdoor stuff like mountain biking and hiking and kayaking, which I try and do lots of. So it's great.
That's great. Great to hear. Uh, let's now switch back to the main topics, the key conversations. Today, we're going to explore key three themes, like areas of interest. Plus, as always, we will finish strong with some audience questions from you, our listeners, and a round of rapid fire to hopefully keep things sharp and engaging. So let's kick it off. The first section, I grouped the questions and things around the theme on sensible investing. Like, how do we know if we are doing the right stuff in our shoes? We are on different level of financial literacy, on different knowledge about the instruments, but still everyone tries to get good return for the proper amount of risk. So the first question I want to ask you about the market efficiency. Are markets intrinsically efficient, and should average investors seek the pockets of inefficiencies for their long-term investing?
Mhm. I don't know if I'd say that markets are intrinsically efficient, but I think that they are pretty efficient as long as they're competitive and liquid, which we know public financial markets do tend to be. I think it's also important to define what we mean by efficient. People throw around this idea of market efficiency. It often gets strawmanned because people will say like, well, look at GameStop, markets aren't efficient. I don't know if that makes sense, but Fama's original definition, Eugene Fama, the academic who created this or formalized the idea of market efficiency, his original definition was a market where prices fully reflect all available information. Now, that can mean a lot of different things, and it's probably a good academic definition, and there's lots of different ways to test that academically. But when we had Fama on my podcast, on the Rational Reminder, he said something that really stuck with me. He said that the best practical test for market efficiency, or the best practical way to think about market efficiency for most investors, is a market where it's really hard for active management to outperform. It's really hard for stock picking and market timing to outperform. Now, I think that's a really nice definition. And if we look at the evidence on that, I would say markets are pretty efficient, and they continue to be. Uh, the level of market efficiency continues to be very stable, despite all the changes that are happening in financial markets and around the world. Now, the average investor, in theory, should hold the market portfolio. Now, even that's hard to define. What exactly is the market portfolio? But call it the global stock market, just as a placeholder, which is not quite the formal definition, but good enough for now. If an investor thinks they can find alpha, which is the idea of earning excess returns without taking additional risk, I think they have to be aware that it's extremely unlikely that they're going to be successful. Now, it's perfectly reasonable to achieve most reasonable financial goals without hitting home runs, without generating alpha. So to me, the trade-off doesn't really make sense. The market's going to deliver sufficient returns to meet your goals in a reasonable time frame. The chances of outperforming that are really low. The chances of underperforming by trying to outperform are really high. And so it just like you don't need the home run to live a good life. And so I don't think most people should try and hit it.
Yeah, makes sense. But I believe a lot of investors, especially when they haven't been humbled by the market, think that, hey, I don't like average. I can be the best. Why should I care about averages? And I think this, all of the wording like passive, average, all of that gives a flavor of for regular investor that this is something you shouldn't strive for. You should strive only for the best. But that's like something you need to live through to understand all the research and evidence and hopefully make better decisions.
I th so
Uh, yeah.
I think you're right, but I think that when you look at the data, being an above average investor only requires earning market returns because most investors are underperforming pretty
You're right.
dramatically.
You're right. Yeah, and actually, like switching to that topic, which is somewhat related to what we just discussed, looking at the evidence, would you suggest that the majority of regular investors, a lot of people on my channel are earning wages at their main job, they're not investing professionals. So maybe they should focus mostly on passive broad market index style investing. And what do you think researchers like SPIVA and similar, papers tell us about the historical odds of beating the market?
Yeah, I mean, the evidence, SPIVA and other academic research included rejecting active management as a sensible investment philosophy or a sensible approach to investing is pretty overwhelming. I mean, you look at professional investors, active managers who are managing funds, they generally underperform. You look at research on individual retail investors, they generally are underperforming pretty substantially as well. So there doesn't seem to be a lot of strong evidence saying that yes, most investors can beat the market or should try to beat the market. There is some nuance. Like we have the episode's not out yet, but we have an episode coming up with Martin Kramers, who's one of the I don't know if I'd call him quite a proponent of active management, but he's an academic who's done a lot of research on active management. He came up with the concept of active share that people may have heard of. Anyway, so his whole research thesis is about finding where active management may actually work. It was very, very interesting conversation. So people can listen to that on the Rash Reminder when it comes out. But just to say that there is some nuance in there. But if we generalize, the vast majority of active managers are going to underperform low cost index funds. I think that's true for funds. I think it's also true for individual investors. And so that makes index funds just a very compelling investment for most people. And particularly to your point, people who are not professionals and don't have the time to dedicate to this as a professional venture.
Yeah, totally makes sense. Let's switch to another topic that is quite controversial in many discussion forums and practical conferences. Let's speak about dividends. I know your general stance on them, but what do you think? Sometimes I get comments from dividend investors in my channel. We try to find some pros and cons of each strategy, but in practice, are dividends really irrelevant, or should folks plan their financial freedom based on future dividend income?
Okay. So for the second part of your question, for that purpose, yes, they are really irrelevant. You're not gaining anything special from investing in dividend paying stocks, and so I don't think building a retirement plan or a financial plan around that makes a whole lot of sense. Now, as with everything in personal finance, there's nuance to it. Like I would say that dividend investors will tend to be better behaved than people who are investing in individual stocks, for example, without focusing on dividends. I think dividends instill a certain level of discipline because people are willing to hold their dividend paying stocks, whether that's a good thing or a bad thing. They're willing to hold them through good times and bad because they are separating the capital portion of the return from the income portion, and so they focus on the income and therefore aren't as affected by stock market fluctuations. So maybe there's a behavioral argument, but it's kind of you're kind of tricking yourself. You're not actually better off. You're not actually safer investing in dividend paying stocks. It's really the same thing as selling some stock. Like it really is. Now, I guess another thing is that if dividend yield makes it easy for someone to think about how much they can spend, because that's another one. Like I think we'll talk about the 4% rule later.
Yep.
Figuring out how much you can spend from a portfolio is that's also tricky. And so maybe dividends can help there as well. They do trade off diversification though. So if you build a portfolio around dividends, call it roughly half of stocks around the world don't pay dividends, and so you're really reducing the opportunity set there. In some cases, not always, but in some cases, they can be less tax efficient than focusing on total returns. And I think another issue that can come in with dividends is people can end up taking too much risk by focusing on high dividend yielding stocks, which may not be ideal. So I don't know. Like with anything, it's pretty nuanced. I really do think dividends are irrelevant. I don't think it's something people should focus on. But it's a tough one because they're so strong psychologically that compared to something like, I don't know, trading options or trading stocks, hey, investing is probably great. But it's not an ideal strategy in my opinion.
Yeah, it's always a spectrum. And as you mentioned, rather than doing something super
Right.
skewed against you, dividend investing may be in that more positive realm if you're still diversifying and not chasing the highest paying dividend stocks. So it
Yeah.
makes sense. And adding to that question, even though some people like dividends, some people don't, but from your experience and overall looking at the market, can a retired person rely on selling parts of their investments and spending dividends as a combo strategy? So dividends can be technically a part of the solution in retirement. Even if someone is not like building the whole retirement on dividends, they still can utilize part of that to live off 4% or whatever other rule in the future.
Yeah, I mean, they're an important feature of stocks. Uh, to say that dividends are irrelevant, it means that dividends are irrelevant to choosing which stocks you should buy. If one stock pays a dividend, one doesn't, or if one has a different dividend yield from another stock, those are not good characteristics to use to choose which stocks you should invest in. But they're still important. Like they're an important component of returns, and an important way that returns are broken down into capital and income. And so it makes sense for investors to use that. I'm not saying people should avoid dividends by any means, but the fact that stocks do pay dividends, for sure, it should be used as part of a retirement plan. At PWL, we do exactly what you just said. We use the dividends that are coming off the portfolio because those are income that are coming off the portfolio regardless. And if needed, we top up the amount that a client needs by selling a portion of their portfolio each month or each quarter, whatever we're doing, and then we send that amount of cash to the client's bank account. But yeah, I mean, dividends are they're there. They shouldn't be ignored. They form part of an income plan in retirement for sure.
Yeah, and as you mentioned, savvy investors should focus on total return, not just on dividend return, but because, dividend return could be here today, but in the crisis, it could go away. There's one of the arguments that's, hey, dividends are paid in every market conditions. You shouldn't rely on selling your stocks that are in the drawdown, but in the crisis conditions, even your dividend stocks can suffer. So let's focus on total return and, of course, make adjustments based on your risk tolerance and your goals and time horizon.
Yeah,
Makes
it's
sense.
another great point. I don't think people should allow their retirement consumption, their retirement spending, to be dictated by the dividend policy of corporations. Because depending on your situation, you may be able to keep spending when markets are down and when companies don't want to pay dividends if you've planned appropriately. So yeah, that's another great point to think about.
Yeah, sure. Let's go to the topic of the negativity in the media and emotional behavior of the investors. They usually go hand in hand. So when we see some bad news, people try to be quite irrational. What do you usually tell clients or your YouTube audience when market doomsayers dominate the headlines and the new fear of a crash starts creeping in? We've recently been through one of the short events. There will be more in the future. How do you usually discuss this negativity bias with anyone you work with?
I mean, I think that the doomsayers always dominate the headlines. That's been true for a very long time. There's actually some research that media has gotten more negative over time, which I think most people would relate to. This time is always different. I mean, we hear this time is different so much, but this time is always different. That is normal. It's normal for this time to be different. Anytime that there's a market decline, it's because that time is different. And it's completely normal and typical if you go back through history for markets to go through periods of volatility. Market downturns are a completely normal part of investing. They may be one of the reasons that we expect positive long-term returns for stocks. And downturns have been happening for hundreds of years. Like we have so much data on historical stock market returns and other asset class returns going back hundreds of years. And market crashes have happened. They've been happening, and most of the time, and that may this may be a this may be like an outcome bias because this system has worked out so far, and so markets have tended to recover. Now, that doesn't mean that's always going to be true, but we've got a lot of history where it has been true. People are resilient, economies are resilient. It's in everyone's best interest for stuff to work out, and historically it has. Now, the fact that there can be declines has to be built into your expectations as an investor. That means having an appropriate asset allocation, recognizing that these downturns can happen and that they can be severe and that they can be prolonged. That also means not investing money that you need tomorrow in the stock market. But there are always going to be doomsayers. It just is what it is. Negative headlines get more clicks. I remember years ago there was a headline from the Royal Bank of Scotland economist who was quoted saying sell everything. And this is I can't remember when it was, but it was, markets have been incredibly positive since then. So that stuff it's always going to be there. And there's the famous there was the Death of Equities magazine cover. I can't remember when it was, but same thing. It was after a period of pretty rough markets, and then they went on to be extremely positive after that. But I don't think investors can let that stuff, the headlines, affect them, or they're not going to be successful. Successful investing inherently requires optimism about the future. And historically, and again, I recognize this won't necessarily always be true, but historically, the optimists have triumphed. It's been a great outcome for people who have remained positive and invested in stock markets.
Yeah, totally agree with your points. Also, I think investors should consider there are a lot of behavioral biases, and the whole papers on them have been written. But I think like recency bias, oh, everything is good, it's going to be good forever, or now everything is bad, it's going to continue and decline would be even worse. And, even considering like, hey, if you have enough of investing horizon, if you're still young and have a couple of decades of compounding ahead, any decline, not a super crash, but any decline is a meaningful opportunity to buy, to increase your positions if your plan requires that and if you follow some strategy like DCA or something similar. So treating them like some sales before Christmas could be even also, a better mental model rather than getting scared and calling the broker sell everything.
Yeah, it's a great point. It does depend on your personal income characteristics. If your personal income happens to be very sensitive to the same things that affect the stock market, you may not have additional income to invest. But for someone who has a salary that is resilient or another income source that is resilient to market downturns, I totally agree. We had one podcast guest, William Bernstein, years ago. He's a great financial author. And he said that young investors should pray for bear markets for exactly the reason that you just said.
Yeah, makes sense. Thanks. Let's now switch to personal investing. Good question. I try to ask people like following Nassim Taleb, don't tell me what you think, tell me what's in your portfolio. So what does Ben Felix personally invest in? I know you usually go beyond like plain market cap funds and incorporate some factor tails. That's what I've seen from videos, from podcasts. In Canada, for example, I believe you use DFA 607, if I recall correctly. And what ETF solutions from Dimensional, Avantis, or others could global investors, not only in US or Canada, use to build similar portfolios with better diversification and exposure to some factors?
Yeah, so you're right. All of my personal liquid net worth is in DFA 607, and that is a 100% equity fund. It's a Canadian domiciled fund that has exposure to Canadian, US, international developed, and emerging market stocks. So it's a truly globally diversified equity portfolio. It owns a broad cross section of all the stocks that exist in each market. So it's got many, many thousands of individual securities underlying the portfolio. So it's one fund, but it's extremely diversified. Now it does tilt a bit toward smaller, cheaper, and more profitable stocks relative to a market capitalization weighted index fund. So market cap weights just take the weights of companies as they exist, and this dimensional fund tilts. It starts with the total market, but then it tilts slightly away from certain types of stocks and toward other types of stocks. So it's going to have a little bit less large cap growth than the market, and it's going to have a little bit more small cap value than the market, and then there's kind of a gradient in between those two extremes. Now, for how other people can invest like this, like it's kind of tough for me to throw out ETF tickers because like different products are going to make sense for different people. Even for where people are, like a U.S. domiciled mutual ETF or mutual fund would probably not make sense for a lot of people, and a UCITS fund wouldn't make sense for other people. So it's hard for me to say like this fund. But Dimensional Avantis and Avantis, they're two kind of similar-ish companies. Avantis actually was started by people who left Dimensional after having been there for many years. But they're both like I don't know, evidence-based product providers that start with market cap weights and then make these evidence-based tilts toward different types of companies with higher expected returns. They both have large ETF offerings, particularly in the US. Avantis does have some UCITS products. Yeah, I mean, but each have a lot of funds, which I guess is one of the problems with choosing the right ones for individual investors. But if you go to like in the Rational Reminder community, I'm sure you're familiar with this. There's a thread on like investing in UCITS, factor investing with UCITS products, and it's like I don't know, many thousands of posts. So you can kind of see that it's not super easy to choose which ones, but yeah, there are people that have written a lot about how to do that. I'm just not the right guy to answer the question.
Yeah, but thanks for sharing your personal perspective. Of course, nothing we share here is any type of investing advice. You should always work with a professional, and as Benjamin, said, define your goals, your risk tolerance, what you need to buy, what products, what wrappers are good for your tax situation, your country, and everything else. But I mean, it's still interesting to see what people do with their own money, just to understand, hey, am I congruent with what I share with the world? Do I follow similar approaches, or am I 100% private equity guy, but on YouTube sharing all the index fund issue? But it's not the case with you. I also shared my portfolio here and will share in the future, and I stick to similar global diversified portfolio. Of course, I have some tilts toward home country, toward Ukraine, but I try to diversify away this risk as much as I can as well, because everyone is different. But I thank you for sharing your approach. I believe some investors, after they graduate from plain index investing, can try to look for some tilts, but beware of possible risks and issues with that.
Yeah.
All right, looking forward to risks and probabilities in life and markets. That's the second big part of the conversation I would like to cover today. So let's talk about the skewness of returns. What does it mean in practical terms, and why it is such an important concept for stock pickers and even for index investors to understand?
Yeah, it's a really big one. So stock returns, individual stock returns are positively skewed. What that means is that most of the market's return comes from a relatively small number of stocks. So a few stocks perform really well. Most stocks perform poorly. In many cases, they have negative returns, and in many more cases, they underperform the overall market return. So that's a big important feature of the distribution of stock returns. Now, the implication is that if you're picking stocks, and this ties back to what we talked about earlier with respect to active management, the implication is that if you're picking stocks with the hopes of beating the market, you are much more likely to pick losers than winners. Now, it's also true that because of that skewness, if you do pick the rare winners, you can win really big. It's just really unlikely that you're actually going to pick the right ones. Now, total market index funds, because they own all the stocks in the market, and I would apply the same thing. Like I just mentioned that I use those dimensional funds. They also own all the stocks in the market. They just reweight them a little bit. But conceptually, like I think from the perspective of skewness, they're still giving you the same kind of benefit. Um, just by owning all the stocks in the market. You're always, because you own that cross section of stocks, you're always going to own the stocks that end up being the big winners. You're going to own the losers too, but just the nature of the way that stock returns tend to work, those few winners, the relatively rare winners, deliver enough return to offset the losers, which is what results in the market return, which, as we know, has been positive for a very long time and should be positive on expectation. So some people might not like to hear that, well, I don't want to buy all the losers. And in many cases, active managers will say that. Why would you buy an index or an index fund when it means buying all the losing stocks? Which is true. You are going to buy all the losers, but you're also guaranteed to hold the winners. And it's really hard. And we know this empirically, like it makes sense logically because of the skewness, but we also know empirically that picking only those winners and avoiding the losers is really hard. You're much more likely to pick losers. There's interesting research on. We had Hendrik Bessenbinder on Rational Reminder podcast. He talked about this research. He's looked at the skewness in individual stock returns. He has a couple papers really documenting that skewness and the extent of it in a way that nobody had before. Those are great papers. But he also has a paper on active management and how skewness affects actively managed funds. And one of the craziest things from that research to me is that the majority of actively managed funds, like I think it's about 55% of them, underperform an index fund before the fees of active management are considered. And that's because of the skewness in returns. And then you add in fees, and then the distribution is much worse, and many more funds underperform. But yeah, so skewness is huge. It just basically means it's that much harder to beat the market because most of the return comes from a relatively small number of stocks.
Yeah, makes sense. Let's talk about mean reversions. After strong bull markets or prolonged economic growth, many investors start wondering, are we inevitably heading into mean reversion? So, also in bad times, maybe somebody can expect positive mean reversion. How should a long-term investor think about this concept? And is there anything they should actually do differently in anticipation of it?
Yeah, I mean, this is such a common concern that investors have, which is funny, right? Because they investors worry when markets have gone down that they're going to keep going down, and when they've gone up, they worry that they're going to go down. But I think the big thing to understand is that all-time highs, because this is really when people get concerned. Market's been going up for a long time, and it hits an all-time high, and everyone's like, "Oh no, if it hit an all-time high, that means it's going to go down." But that's not really what happens when you look at the data. So we looked at this in a paper a while ago. We use monthly total return index levels. So we track the total return level of the index of a bunch of different indexes over time. And depending on the index that you look at, it's somewhere between 15 and 30% of months are all-time highs for the total return index. So they're pretty common. So it shouldn't be something like, oh no, this is abnormal. It's like, no, this is kind of what happens because markets have tended to go up over time because the underlying businesses have tended to be successful enough to continue moving things in the right direction. The other really important data point here, though, is that all-time high months are rarely followed by market declines. So that's again, people worry about, oh no, we're an all-time high. Okay, well, they're actually pretty normal. And most all-time high months, about 2 to 3% of the all-time high months in our sample, are followed by a drop of 10% or more within 12 months. So all-time highs are normal. Significant drops after all-time highs are pretty unusual. So I don't think for both of those reasons, I don't think that an all-time high is a sign that the market is going to mean revert. Now, again, as with anything, we can add some nuance. Like when market valuations get really high, they've come down now a bit, but in the U.S. for a while, market valuations were getting really high. That could lead you to revise your expected return assumption for a market downward. But that's a little bit different from saying, oh no, we're at an all-time high, the market's about to crash. Now that paper that I mentioned we did a few years ago, we called it Buy the Dip. It's available online if people want to search for it. But we looked at 8 different stock market indexes, and what we were asking in that paper is if it makes sense to wait for a market decline before investing in the stock market. That's again a very common thing where people will be like, "I've got this money to invest. I'm worried the market's going to drop, so I'm going to wait for that drop to come and then I'll invest." So in the paper, we looked at a bunch of different starting months throughout this sample period, and we looked at holding treasury bills and then waiting for a 10 or 20% decline in the stock market before investing. And we compared that in each month to investing immediately at that time. And we did have one specification in the paper where we looked at buying the dip, starting in months that were all-time highs. So that's why we had the all-time high data in that paper. And we found that buying the dip underperforms investing immediately in most markets most of the time. And it, on average, costs a lot due to the opportunity cost of not being invested. So I think this comes back to having an appropriate asset allocation and having a plan that you can stick with through good times and bad external circumstances. Like, oh no, the market's at an all-time high. Even if that did indicate that there was going to be a crash, it shouldn't be a reason to change your investment strategy. But also, as I just explained, it does not mean that there's going to be a crash.
Yeah, totally agree with you. For listeners that would listen in Ukrainian, you can go back to my Goals on Fire episode 32. It's from 2021. I covered part of that research that Ben refers. Here in the channel, we try to get the best and most well-researched data and translate it to Ukrainian to help people follow that. So I remember that 2021 craze where everyone was like, "Oh, how much higher can it go?" And all of that. But we are much higher today, and hopefully will be higher in the future. But yeah, that's a good research that reminds you that opportunity cost is quite high here. So let's yeah not make stupid decisions and let do not allow the market fluctuations to sort of influence your decisions with your investments. Uh, all right, moving next to looking at the like broader history. We have seen in the many years that stock markets operate, entire countries or markets failed, vanished, or stopped operating for some period of time, from wars to political upheavals. What lessons should the average global investor that usually invests not only in one country take from this example when it comes to global diversification and portfolio design?
Yes, this is a really, really complex topic because so many different things have happened throughout history. Like you mentioned, markets failing, vanishing, or stopping operation from things like wars and political upheavals. There's so many different versions of that that have happened over time. Like some markets have just had really, really bad returns, but not necessarily been expropriated or shut down formally. And then some have been formally shut down and assets have been seized. So it's really hard to say kind of what the expected distribution of those extreme outcomes is in the future. Even in the past, it's not super easy to study what has happened because I don't think the data on certain types of asset confiscation are very good. Some markets have closed entirely. Like there's a couple examples historically where markets have been completely nationalized or shut down, resulting in total losses for all investors. Some markets have closed only to foreign investors, resulting in losses for them. And like I mentioned before, some markets have just had really bad long-term outcomes, just really bad returns without any interference necessarily. Now, global diversification is good because any individual market can perform poorly over a long period of time. I think the classic sort of relatively modern example that's still ongoing today is Japan. And that's a country that in the 1980s was one of the largest stock markets in the world, had insanely high returns for a long time. But since then it declined in December 1989. And then, from December 1989 through May 2025, it has returned an annualized nominal, so not accounting for inflation, not accounting for what you could have returned or earned in a risk-free asset, 1.44% in US dollar terms. And that's like, you know, that's rough if you're 100% invested in Japan. Keeping in mind that before its decline, I mean, and still it's one of the strongest, most developed economies in the world today, but before its decline, its stock market specifically was one of the largest and most successful stock markets in the world. So that's the example of like you don't want to go all in on one country that ends up being uh, Japan. Now, so you diversify, which makes sense into other countries. On the other hand, though, in times of war and political upheaval, foreign investors, I kind of mentioned this earlier, foreign investors don't tend to be treated very well. So that's like global diversification is good because you don't want to invest 100% in the one country that ends up being really bad. However, uh, investing in foreign countries has some unique risks that I think are kind of hard to think about and hard to account for. This is another thing that when we had Eugene Fum on our podcast, it's something that he talked about, and I've thought about it a lot ever since then because it was not something that I really expected him to say. But when you think about it, it makes a whole lot of sense. So at PWL, and you mentioned you do this too, at PWL, we approach this by having a pretty meaningful home country bias. We have about a third of our equity portfolios in Canada. And my personal portfolio, like DFA 607, the fund that I use, is also 30% in Canada. Now, Canada represents about 3% of the global stock market. So it is a significant home country bias. And then for the rest of the world, we market cap weight global stocks. So that ends up being at the current market cap weights, that's roughly 44% in the US, 16% international developed, 8% emerging markets, with the remainder in Canada.
Yeah, thank you for sharing this. And also on the topic of risks and understanding the global situation, living here in Ukraine, many of my friends and fellow Ukrainians face multiple risks every day due to the Russian invasion and attacks on peaceful cities. People face challenges that are far beyond the closed stock exchange or transactions
Mm.
limitations due to wartime. And as I shared in my short story for the Pathfinders book by Jelly Collins, sometimes the biggest risks are not related to economy or inflation, and we have to be grateful for what we have, who we love, and great people around us, live in the moment as well. Because looking only into the future that may come, may not. It's unpredictable. You can't exist only by expecting something much better later down the road. So broad diversification, of course, avoiding too big of a home country bias, like 100% home equity, totally have been sound frameworks for Ukrainians as well in
Mm.
this current wartime. And of course, global investors shall appreciate it as well. And I think, like, when I think about risks in broader terms, one of the quotes that I like by Morgan Housel, risk is what's left over after you think you have thought of everything. So after you thought of everything, there is still going to be something that's unexpected. You can protect yourself, you can use insurances, diversify, but still be ready that something else going to knock on your door. Yeah. Switching from market risks to personal risk and also some unexpected stuff. Sharing personal experience can be impactful and sort of hard, but I know you have recently spoken publicly about a health diagnosis that was a shock to many listeners and, of course, to you and your family, definitely. So, how has this experience shaped your perspective on risk, both personally and professionally? And has it influenced how you think about financial planning, decision making, or living in general?
Yeah, so I decided to be super public about this just for two main reasons. One is that this like doing the my podcast and doing stuff like this is a huge part of my life, and it would be really hard to hide something like a medical diagnosis while continuing to do that because I had appointments and I missed a couple podcast recordings and stuff like that, and so it would have just been kind of awkward to try and hide it. That was one reason, and then the other reason was that my audience is largely the demographic group that is at risk or most at risk for the diagnosis that I received. And so I decided, like, okay, this happened to me. It's relatively low probability, but for the group specifically that tends to listen to my content, it's a higher risk than for other people. So I figured by being public about it, I might help some people. And actually, I have had people write me to say, like, hey, I heard you tell your story, and it ended up with me going to the doctor, and I ended up actually getting diagnosed with the same thing. And like, you may have saved my life. And it's like, man, okay, I'm glad I shared it. Anyway, so let me just talk a little bit more about it. Has it changed my perspective on stuff or influenced how I think about things? Not really. Uh, just because I was always really aware of health risks. My mother had breast cancer when I was a kid, when I was, I think, 12. And she was given very poor odds of surviving. She had to go through pretty serious treatment, chemotherapy, and surgery and stuff like that. She survived, and she's still super healthy and involved in sports and stuff today. But that was a rough time for our family back then, and it was a rough time for my mom. And so ever since then, I've been super paranoid about health risks and about cancer specifically. Like, it's probably not healthy, but I would, I would always worry about any irregularity or anything. And a couple of years ago, one of my testicles, the right one, if people care for that level of detail, started to hurt. It just didn't feel right. And my wife, I told my wife, she pushed me to go see a doctor, which led to that testicle being monitored with periodic ultrasounds. So I went, had a first physical exam. Then they sent me for an ultrasound, and I then got into this kind of system with a urologist and going for these ultrasounds. And at first, it seemed like there was nothing there. The urologist was like super unconcerned. It was this tiny little thing. But the protocol is to monitor for a period of time. So I had to do these every few months. I'd go in to do another ultrasound, and it was fine. It was fine. It was fine. And then it wasn't. It was eventually had grown to a size where it was deemed suspicious of being cancerous. Now they can't do a diagnosis from an ultrasound, and so the protocol, at least in Canada, I believe this is the general protocol though, is to remove the testicle once there's suspicion of cancer. So that was like wild because it was like ultrasound, whatever, no big deal. It's kind of in the back of my mind, like this is a concerning thing that I'm monitoring, but seems fine. The urologist isn't concerned. And then it was like, okay, no, this testicle has to come out. And so I was told that in person by the urologist. And then I can't remember, it was like 3 weeks after that or something. I had to go into the hospital and have this surgery, which was pretty wild. And then you have to wait a while to get the pathology back because they've removed the testicle, and then they can do the diagnosis after that. So I had that surgery. That was January of this year. And then a few weeks later, I can't remember how long it was. At the time, it was way too long between surgery and diagnosis. Like, man, I have no idea if this is cancerous or not. Anyway, so it did end up being early stage, highly treatable testicular cancer. It was like the earliest stage possible. I think it's called PT1A, and it was seminoma, which is the most treatable type of testicular cancer. Crazy experience though, because it was so early stage and there was no spread. Like I did staging CT scans and stuff, no spread. So I have not had to do chemo or radiation, which I'm grateful for, but I do have to continue monitoring for recurrence with blood tests and CT scans for the next 5 years. And if there is recurrence, that's possible. I would have to do those more extreme treatments. But again, it didn't really change my perspective because I'd always worried about something like this happening. Uh, it was almost like it was almost like, okay, finally, this did happen. I've always worried about it. Um, but it did make me more likely to kind of err on the side of, I don't know, like YOLO when making day-to-day decisions. Like, I don't know, little stuff like going out to dinner or planning a trip or taking a day off work and that kind of thing. Like I think after this recording, I'm gonna go take my daughter to the bakery and maybe take a few hours off and just kind of hang out. So I'm more likely to do stuff like that than I was before, just having gone through that. But overall, I don't think it changed my perspective much, just because of the experience of seeing my mom go through it. Kind of colored my perspective on health risks.
Yeah, thank you for sharing, and definitely you're impacting a lot of other young people who can test themselves. And as you mentioned, there have been already listeners who caught it also early. Thankfully for you, it's a sort of positive outcome, and I hope nothing's gonna return and you're gonna remain healthy. So happy for that outcome. And from my side, in recent years, I've also faced some unexpected health risks, the kind you wouldn't usually anticipate in your early 30s. For me, it was in a way sort of life-changing experience in terms of working with odds decision making and understanding the true value of time and health. What you just mentioned, doing more things now in the moment because you may know that hey, something can be bad, or even you can live but you can be so unhealthy, for example, that you couldn't enjoy daily minutia, daily details of being with your family, with your loved ones, and doing stuff you like, your work, your job, working with cool people. So I totally understand that, and I think I'll share some more details in one of my next episode later, because I do from time to time what I called like health and longevity portfolio episodes, where I share more about my like health and what do I do with my day-to-day training. So just to wrap up this stuff, I like totally connect with everything you said, Ben. And from my perspective, just a reminder, please, listeners, whoever is watching us, don't skip your regular health checkups. If something feels off, even if it looks like, oh, nothing, not a big deal, just as Ben mentioned, check it. It may just save your life or at minimum improve your well-being and sort of add some peace of mind. You would sleep better and know that either you're tackling the problem early, like in Ben's case, he didn't wait for long, or you at least know there's no big deal. I will just monitor my health down the road.
Yeah, actually, you know what? Just on changing perspectives, one thing that I have taken much more seriously is health stuff like uh, preventative and pre-diagnostic type things. Even stuff just like going to the dentist, stuff that I would very often put off, and then finally after whatever 2 years go to the dentist or going for a doctor checkup. I've been much more diligent with that kind of stuff and much more willing to, not have any meetings for an entire day and just take that day to go and do health related things. So yeah, I think that's a really important point for people to take away. Because if you keep putting it off, like in my case, if I'd kept putting it off, the outcome could have been far worse. And even if the outcome had ultimately been similar, it could have been a much more difficult path to get there with more aggressive treatments and things like that.
Yep. Thanks for sharing that again. Now we will continue with the third big block. The next theme I wanted to explore with you, Ben, on values and meaningful life. The first question is around the PERMA-V model. You mentioned in several Rational Reminder podcast episodes and your research. It provides a framework for balanced well-being and decision-making in terms of what you're doing with your life, with your finances. But looking deeper into your own experience, do you use it in your personal life and planning? And what specific aspects of this PERMA-V do you believe are most relevant to DIY investors seeking a more fulfilling life from your perspective?
So I really like this model, and you know, I probably like it because it's a multi-factor model for living a good life, and I tend to like we talked earlier about tilting towards certain types of stocks. That stems from a concept called factor investing, which stems from a concept called multi-factor asset pricing, and multi-factor asset pricing is done with multi-factor asset pricing models that tries to sort of attribute returns to certain characteristics of stocks. So I think multi-factor asset pricing makes a lot of sense. When I read about this model for the first time, I was like, oh my goodness, there's a multi-factor model for living a good life. This is incredible. The model was designed by researchers in this space, a researcher in this space, to capture like the fundamental, the most important factors for living a good life. So I think that they're all relevant, and that's kind of the purpose of the model. I do think about the model daily, which may sound weird, but it's I try I don't explicitly think about like a checklist of all these things, but I do try to think about just how am I spending my time in that moment. So like the model is positive emotion, engagement, relationships, meaning, accomplishment, and then vitality was added later. So that's PERMA V. So positive emotion, like I try to check in with myself throughout the day and make sure that I enjoy what I'm doing in the moment. And if I'm not enjoying the thing that I'm doing at the moment, I'm going to be asking myself if it contributes to one of the other upcoming factors in the model. Am I doing this thing that I don't enjoy right now, but I know it's going to contribute to some other thing that I'm going to be happy about later? If it doesn't, if I'm not enjoying it and it doesn't contribute positively to one of the other factors in the model, I'm going to consider whether I should really be spending my time doing whatever I'm doing. And I've got other little small pleasures. Like this is kind of a like really small thing, but I really like having a cup of black tea in the morning. It's, I really like it. Likewise, like going to the local, we have a really good coffee shop in the town that I live in. Going for a coffee or like taking my daughter to the bakery, which I'm probably going to do later. Little things like that. I try to do little things like that occasionally. So that's the first factor in the model. Engagement is the next one. And again, like I want to make sure that I'm doing things that are challenging where I have enough skill to enjoy the challenge. That's kind of what engagement is supposed to be. So playing basketball, I play basketball in this league on Monday nights right now. Played last night. It's really late. Like my games start at 9:30, so it's a super late night for me. I usually go to bed really early, but it's okay. I deal with it. But it's a league where most of the people playing are these like 19 and 20-year-old kids, and they're really good basketball players. I'm 37, so it's like, I'm playing against these guys that are way younger and more athletic than me, but it's challenging and it's fun. So like stuff like that, I think is really important. Similarly, like professionally, reading an academic finance paper that I think has some useful insights and kind of figuring out how to communicate that to people in a way that they will be able to find it useful without necessarily having the ability to read an academic paper themselves. That's another challenging task. Writing, like sitting down to write a video or write notes for a podcast episode, that's another thing where it's like it's genuinely hard to take information. I mean, if anyone who has written things understands that writing something is very, very different from talking about it or reading and thinking about it. writing down your own thoughts and formalizing, especially if you're going to speak them, it's a whole different element of learning and understanding. So that's another one. Mountain biking, like I have a really good uh, area that I live in for mountain biking with some really nice technical trails that are challenging, and so like going out to one of my favorite trails and completing more of it without getting on off the bike than I did the previous time. Like that's like super satisfying. So those are all engaging tasks, and that's like it's related to the concept of flow from a guy named Mihaly Csikszentmihalyi, who kind of found this idea that people find being in a state of flow very, very satisfying. So I try to find that daily. The next factor, relationships. So that's I try to make time with family and friends a priority. Being on a basketball team contributes to that. I've got this core group of guys that I play pickup basketball with throughout the year. That contributes to that too. I've got a friend that I meet up with once a week to lift weights, and then we go out for dinner afterwards, and that's another thing. Having relationships with, like, we're having this conversation now. This is the first time we've met, but we have this kind of asynchronous relationship, and I have that with a lot of people that listen to my content. And that's also really really cool. Uh, and I mean, yeah, family is another big one there. Meaning, I want to make sure that I'm contributing to something greater than myself. And again, doing my podcast, doing things like this, I think really contributes to that. I find it really gratifying to know that other people are reading the stuff that I'm writing or listening to my content or watching my videos, whatever. Um, yeah, so that's good. Accomplishment is like doing hard stuff. Like again, writing a video or podcast episode, finishing it, recording it, seeing it get published. That's accomplishment. Winning a basketball game, finishing the CFA exams. That was like that was up there in terms of feelings of accomplishment. I finished all three levels consecutively, and when I wrote that last exam, I was sure that I had not passed. And when I got the email from the CFA Institute saying that I'd passed, it was like, wow. So that's accomplishment. I think setting and achieving goals that matter to you is something that tends to make people feel pretty good. And then vitality is the last one. So we've gone through all the PERMA, and then the V is like eating well, exercising, sleeping well, and I try to make those fundamental parts of my days every day. So I do think you need all those things in some capacity to be able to really enjoy what you're doing minute to minute, which is really just kind of, I mean, positive emotion engagement are kind of enjoying what you're doing minute to minute. And there's these two broad ways to break down happiness, which is one is hedonic happiness, like that's enjoying what you're doing minute to minute, and then reflective happiness or eudaimonic happiness, which is being able to step back, look at your life, reflect on it, and be like, yeah, I'm happy with my life. So I think you need to kind of go through all those things to be able to do those two things.
Yeah, thank you. And I like the comparison to like managing a portfolio and considering all the proper ingredients for your situation, for your priorities. This is similar to, hey, we're not going to be balanced in all of the areas at any given moment. Something's going to be in the drawdown, something's going to be higher, but we can balance it out and see, oh, my relations suffer. What can I do in that area? Or I hadn't been working out lately. How can I change it? So this framework definitely gives you some foundation on which you can build better life you would enjoy in your situation. It shouldn't be the same like Ben's life or my life. In your case, it would be totally different, but still you can utilize this framework. And again, for listeners who are listening this in Ukraine or for Ukrainians, we have discussed this framework specifically based on the Rational Reminder research, and it's the Goals on Fire episode 57. We explore and explain this framework and financial goals master list that Ben and colleagues prepared. It helps you to sort of align your values and not chase, something that's shiny or everyone goes for it. You can better define your values, what you want to live by, and then fund that good life. So this is another reference to that episode. Please check it out if you wish. Let's switch to the topic that is discussed here on this podcast quite frequently. It's not just the FIRE Financial Independence Retire Early podcast, but it has it in the name. It's the play of the words, igniting the fire, igniting the goals. So you have researched and reflected a lot of topics, but also I know you dove deep into the FIRE movement, Financial Independence Retire Early. Could you please walk us through some of the key pros and cons you see in this approach? Is achieving FI, financial independence part, something you personally strive for, or do you see it more as like a flexible philosophy rather than a fixed destination? What is your opinion?
I think there are a lot of different perspectives on and even definitions of fire. I think the sort of classical definition of saving, 50 to 75% of your income to achieve what I would call the perception of financial independence as early as possible. I think the downsides there are that 25 to 50% of most incomes is pretty tough to live on. And I think that achieving financial independence at that level of spending, if you're living on 25% of a regular income, which is a pretty frugal lifestyle. Now, money doesn't necessarily make people happy, but um, I've I've had less money than I have now, and it's a lot more enjoyable having more money and being able to spend on things and do what you want. So achieving financial independence at a really on a shoestring budget, that doesn't seem very free to me. That doesn't seem very independent. I understand it's independent from the need to work to with the ability to live at that income level or that spending level, but that doesn't really seem independent to me. Like I guess you're free to eat ramen noodles. I don't know if that's a thing in Ukraine like it is in North America, but it's like what poor students eat.
Yeah, some
And
people do that here too, but
Yeah,
I
okay.
hope after graduating from university, you can earn a bit better and not live on ramen and noodles
Yeah,
moving
yeah,
forward. I
exactly.
agree it's a balance, and we here don't, advocate for just reach a high number as soon as possible, remove everything else from your life, and postpone all the joys when you're 50 or 60 and miss your best year. So I agree it's a balancing act. Everyone decides what they need to do, but definitely I'm not in the camp of super savers.
Yeah, yeah, yeah. And then the other thing I think is that work, like we went through the PERMA model a minute ago. Work can provide many benefits. Like I referred to some of the ways that I extract value personally from the things that I do for my job, like writing and doing the podcast and doing research. Work's not the only way to get those things, but it's one of the best ways. I mean, even relationships and meaning, contributing to something bigger than yourself. Like again, work's not the only way to get those things, but it's a pretty good way. From talking to people who are pursuing fire, I think they do recognize that, and they do plan to continue working, just maybe in a different job or maybe taking more risk with what they're doing for work, which is fine. But I also think that if the plan is to continue working and earning an income regardless, then again, if we're talking about an overly aggressive saving strategy to get there, I don't think it's necessary. But now I don't want to straw man fire because, like I said earlier, that was kind of the original concept of it. I think it's moderated a lot over time, and I think it's come to mean different things to most people. So I try to be careful not to straw man it, but I think if that specifically, if the extreme saving and frugality is what people are talking about when they talk about fire, I don't think that that's healthy or productive. Now, I think to most people, what fire seems to be is a way to think about saving money for the future that makes the trade-off between current consumption and the need to work for money in the future very explicit. That is valuable. That's healthy for most people to reflect on. And it's something that I don't think people tend to think about. And so when they hear about the concept for the first time, it's like, wow, this kind of eureka moment of realizing how current consumption affects your future. So connecting your spending to what you actually value, and again, we can come back to the PERMA model. A lot of the things in the PERMA model don't require spending a lot of money, and so connecting your spending to what you actually value in life is very worthwhile for anyone to do. And for a lot of people, I would not be surprised if that does result in reducing spending because you realize you're spending money on stuff that's not bringing any value to your life. It's not contributing positively to the factors that matter to you in the PERMA model. And that would inherently increase your saving for the future and accelerate the path to financial independence. So some level of that reflection, I think, is really important without taking it to the extreme. And again, I don't think most people are taking it to the extreme. And it sounds like that's what you're talking to your audience about, which is great. Recognizing the time versus money trade-off, that's also valuable. Like you work, you spend your time working to earn money, but if you had more money, you would maybe need to work less. Understanding that is really great, but I think so is pursuing work that you enjoy and that pays well. Um, which again is something that I think can get uh, muddied up a little bit or even lost when people start thinking about fire. Personally, I don't pursue any form of fire, but I'm a pretty good saver. I don't consider myself to be pursuing fire, but I've always been a reasonably good saver. I thoroughly enjoy my work. I have no interest in stopping what I'm doing. I'm also not in a precarious financial position because I've always been a pretty good saver and I don't have like crazy amounts of debt or anything like that. I've always been pretty intentional about my spending, I guess is the other side of being a good saver. Um, I don't know, like I could at this point in my life, if I really wanted to stop working and I wanted to live the extreme kind of fire lifestyle, I could probably do that now. I could live on ramen noodles and, you know, uh, reduce my spending in other areas. So I've sometimes joked recently that maybe I was pursuing fire all along and didn't realize it. But I don't think that the concept of fire is for people like me because I really enjoy my work. I guess I was somewhat intentional with my spending and thought about this stuff anyway. So it's never resonated with me personally. However, for someone who's like spending all their money on frivolous things, like I don't know, ordering a bunch of stuff from Amazon and Temu on their credit cards, I don't know what else is frivolous. Leasing really expensive cars that they don't need, other stuff like that. And if they're working so much to afford those things that they don't see their family, like, okay. And maybe they hate their job too. Like you take someone in that, it's kind of a caricature. Like I don't know how many people are actually in that situation. But for that person, fire is like an incredibly powerful message. So overall, I think fire is a form of self-help. And there is research that has contextualized fire specifically as a form of self-help. I don't think that's a bad thing. I've said that in our podcast, and people have gotten upset, but like it's what it is, and there's nothing wrong with that. And I think it probably has helped a lot of people by making them think more intentionally about the time versus money trade-off and the current, present versus future trade-offs. There's definitely value in it. I sometimes worry that it can be taken to the extreme to the detriment of some people's lives.
Thank you for sharing that perspective, and I believe each and every one of our listeners can take something away from that discussion we are having today. Because, as you mentioned before, PERMA-V model, understanding what you value most, where you actually allocate your time and money. This tells a lot about what type of person are you, and what is important for you. Because somebody will spend on this stuff, somebody will spend on that stuff. I also agree that all of this show off consumption, like shiny objects and sort of trying to prove yourself to the outside world, is not great. It doesn't have anything to do with fire, but it's better to build a wealth that people can't see, something that's on your banking accounts, investing accounts. You can be in simple clothes on a regular well-performing car, but still you can be much better off than somebody who is showing off. So it's always a personal decision. Fire is not for everyone, and I also agree that each person should define the flavor of financial independence if they want to reach it or not. Somebody wants to retire, somebody, as you mentioned, would like to continue working, but maybe have more free time or do part-time stuff or switch to some more adventurous things like their own business or something. And I also agree that anytime you watch some content on YouTube or anywhere else, do the background checks. What is this person actually doing? What are his or her motives? Because sometimes there is a lot of bad financial advice and people try to follow some role models that they shouldn't in their situation. So do your checks and filter out the information. Better follow Ben and his channel and his colleagues. If you like, follow me. And of course, make your own decision based on your own life situation.
And, it's interesting too because financial independence is at some point a very normal part of financial planning. Like if you think about how economists look at the life cycle of a typical investor, You start out with little assets and a low income. Your income increases over time. You save a portion of that income, and then at some point you become financially independent. So that timeline is normal. And I think FIRE is just talking about shifting the timeline a little bit, shifting the curve of financial wealth and how it relates to human capital over time. So it's not a radical idea in the sense that everybody at some point should seek to be financially independent. It's really just managing the trade-off of when you want to be able to achieve that, how you define it, at what level of income you want to be financially independent, and what sacrifices, if any, you're willing to make to get there. So it's just there's a distribution of levels of saving and timing of retirement where it can be really extreme, but it can also be totally normal. And I think most people are going to fall somewhere in between those two, which is fine. But I do think FIRE as a tool to think about that is useful because it's financial planning can be really hard to think about. FIRE found a way to make it easy to communicate to a lot of people, which is why I think it has been able to help a lot of people.
Yeah, I agree with that statement. Dear listeners and audience, if you enjoy our conversation with Ben, please check out other Goals on Fire episodes available on YouTube and multiple podcast platforms. Please like, share, and subscribe to the channel and leave us your comments and reviews. What do you agree with? And how does your investing approach differ? What you liked, what you didn't like about our today's discussion. Thank you. I would appreciate your comments and feedback. And we are moving along in our discussion on values and meaningful life. That's the third block we have here. I know, Ben, you are a father of 4 kids, ages 10 and below, if I'm not mistaken. With all the load and additional stuff that's on your shoulders, how do you manage to sort of harmonize your responsibilities across family life, research, work, YouTube, and podcasting? It's something like I juggle with. My family is relatively young and my daughter is under 1, but I see myself also trying to balance this. I'm curious, how do you do that in your life?
Yeah, my oldest son is 10. So yeah, you're right. My youngest daughter is 5. But yeah, four kids. I don't know, man. Like my kids are in school most of the day during the week anyway, so it's not, there's a rush in the morning to get them off to school, and then there's a bit of a rush in the afternoon when they come home. But they are at school most of the day at this point. It was different when they were younger, I guess. My wife is at home full time. She's a student right now, but she's been at home with the kids uh, the whole time that we've had our family, so that helps a lot. My job does let me have quite a bit of control over my time. Like I have serious responsibilities as the CIO of a firm that's managing billions of dollars for Canadian families. But that doesn't mean that I need to be tied to a desk 12 hours a day. Like it's not uncommon for me to work on a weekend. If I need to get some work done, I did that this past Sunday. I worked for a lot of the day, which didn't feel burdensome. Like it wasn't a big deal. The kids were playing outside and whatever. I still saw them in the morning and in the evening. But then yesterday, which was Monday, I worked a bit and then I did take a couple hours off in the afternoon to go for a hike with my wife and daughters because it was just a nice day out and the daughters were home from school. I think one of them had a cold, and one of them is in preschool, so it's only a half day. Anyway, so I did some work in the morning, took a few hours off, went for a walk in the forest, and then came back and worked until the evening. So being able to do stuff like that, I think, makes it fairly easy to balance uh, family and work. There is a lot of work that I need to do to keep everything running. Like I have my CIO work, which involves research. It involves interacting with our portfolio managers and financial planners, sometimes interacting with clients. I don't want to minimize the fact that I work a lot and there's a lot for me to do. Like not to mention the content that the videos and the podcast. That's also a huge amount of work. Um, so I've been asked by people like, kind of this question, I guess, how do you balance it all? And I mean, part of the answer really, and people don't love to hear this, is I do work a lot. Uh, there's no hack, there's no secret. It's like you want to do a lot of stuff. It just sometimes means working a lot, but I think I'm also pretty good at making time for my family and for the other things. Like I mentioned, I played basketball last night, which was, like I said, the game starts at 9:30, so I'm with my kids all evening, and then I go play basketball. Mountain biking is another thing where it's like pretty easy to slip out and go for a quick hour ride. Lifting weights, same thing. Yeah, I think it does help that I enjoy the work that I do, like researching, reading the papers for an upcoming podcast guest is like I find that super enjoyable, and it often does impact my my CIO work. Like there can often be messages that I'll take away from that research and go and talk to our portfolio managers and financial planners about it. So that the work never feels exhausting, even though I am working a lot. So that might be the biggest hack, I guess, is finding work that doesn't really feel like work.
Yeah, good point. And I think not looking for some cheat codes, but being honest with yourself, especially while you're, juggling so many responsibilities. Yes, you need to work hard and work a lot to be able to afford having more flexible schedule. Maybe somebody is doing remote work, depending on person's life circumstances, we can all adjust a little bit, and there's always trade-off. Do I work for more money and engage more, or do I still have flexibility to see my family, go for a walk or weight training or go for a run? So, thanks for sharing this. I definitely believe that there is no like cheat code. Usually, just people put in the hard work, and if you persist, if you're consistent in investing and work in professional life, getting certified, moving higher, the ladder you like, not the one imposed by you, by somebody, like you need to be on that level. Somebody is okay staying in middle management, somebody rises to the top. We all are different, but I agree you have to find your own path. And as you mentioned, if the work doesn't feel burdensome, it's much better because you like what you do, even if it's Sunday or whatever is the day. All right. Now moving on to sports and building a fitness foundation. We already touched based a little bit on this. Let's talk about health and longevity. Obviously, you look and feel like you're in the great shape. I hadn't seen you in person, but that's my impression. You mentioned you lift weights, and I think you stayed quite active. You mentioned some different types of sports you like to do. Can you share more about your approach to training and well-being? I heard in one of the recent podcasts you mentioned that sometimes you used the Caliber app. Has it helped in building your routine and stay consistent? And what do you usually do? Because like even in this podcast, I always say, hey, even if you build large capital, you have to be healthy enough to enjoy it while you're young, and then later to have more good years to your life, not just years checked off the calendar. So, what do you usually do?
Yeah, I love that. I haven't written anything down yet, but I've been thinking about a video and a podcast episode on investing in your health, talking about all that kind of stuff. And the point you just made is super interesting. I've got Canadian data, but I'm sure it's similar elsewhere on the difference between lifespan and health span. And so you can see that people live to a certain point in their lives, but their years of being healthy while alive are generally much shorter. And so you definitely want to increase your lifespan, but you also want to increase your health span. Living a long time and not being healthy does not sound so great. And there's really interesting stuff too, at least in the Canadian data, on the difference between lifespan and health span uh, relative to income levels. Like lower income people tend to have lower lifespans and lower health spans. Anyway, I think that's all a really interesting idea, and just thinking about how people can live longer, but also live longer being healthy.
We will
Uh,
definitely look for that episode in the future. It's a great idea.
yeah, I need to sit down and write it. But I've read Peter Attia's book. I don't know if you read that. Outlive.
Yeah, I recommended it to multiple people. It's a great one,
Okay, yeah,
Outlive by Peter Attia.
yeah, yeah. So I think he says lots of good stuff, and I think he makes interesting points too about how, as much as there's science to longevity, there's also a lot of art. Just because we can't test a lot of the ideas because we don't have we don't have the data. Like we
It's
have,
always the sample size of one. You have to test on
right.
yourself to see what's working, what's not. I agree.
Yeah. 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 So anyway, I did use Caliber for a bit. You know, I played NCAA Division One basketball, and for 4 years I had this like intense training regimen. And for years after that, I was super comfortable just walking to the gym and thinking up a workout. Um, because I guess I had so many in my head from doing that. But then as time has gone on, it's gotten a little bit harder for me to think about that. So Caliber is an app that generates workouts for you based on your objectives. It's a free app. I think they try and upsell you on like personal training services through the app, but I just used the free version. It was great. I haven't been using it recently because I guess I have committed most of the workouts to memory at this point. But still, it was a great starting point. I do try to lift weights, uh, typically bare minimum once a week because I mentioned earlier I've got a friend that I meet up with at the gym and we lift for like an hour or so and then we go have dinner together. That's a I didn't mention that earlier actually, but with the perma model, there are many cases where you can combine things. Like that's a case where that's building relationship with this good friend that I have, and
Yeah.
then we're also exercising. So I think there are often opportunities to do stuff like that. Like I don't know, going kayaking with a friend, or like I went for a hike with my family yesterday, all that kind of stuff. Anyway, so at least once a week I'll lift weights. We train pretty hard. Like if we're not super sore the next day, we consider it a failure. Um, we'll text the next day like how sore are you? And if we can like poke our muscle and it's not painful, then we think it was we didn't push ourselves hard enough. I try to work out more frequently than that. Sometimes that gets a little tricky. It's like it's really useful having that sort of commitment device where it's like my friend is coming, we're meeting at the gym, we're going to lift weights. That's a lot harder to skip than it's 7 o'clock and I haven't worked out yet and haven't eaten dinner yet. So it's really easy to skip that workout. But I do try to lift weights more than once. I have Olympic rings hanging in my kitchen at a height that I can do dips. So that's pretty easy. Like I'll do some dips in the kitchen while I'm cooking or whatever. And then I do also have Olympic rings in my garage that are at a height where I can do pull-ups. So again, like that's an easy thing that I'll try and do. If I don't do a proper lift one day, I'll try and do at least a little bit of that type of body weight stuff. Uh, and I do have a gym in my house with like a bench and dumbbells and stuff. So that also makes it easier to work out kind of at the last minute. And then I mentioned earlier, I play basketball once a week. That's like pretty intense, high level basketball. I try and ride my mountain bike a couple times a week. Do other outside stuff like kayaking or whatever. Not a super systematic approach, but like the in very simple terms, I try to sweat once a day at least. And I do track stuff. Like I track my bench press and my grip strength and my VO2 max and flexibility to make sure I'm not deteriorating.
Great. Yeah. Thanks for sharing your approach. In my case, for weight training, I use the app called Heavy. It also helps you to sort of track the progress. I could use Strava for walks or jogs. And in my case, since just like you, I'm a little bit of data slash metrics junkie. I like to see the actual progress. Am I not deteriorating? Is my VO2 max at least stable or getting better? So I just like to track things just to have objective data. When I'm just basing it on gut feelings, oh, looks like I gained a bit, but was it fat? Was it muscle? Can you go on the proper scale and check yourself? Is it actual gains or not? So I totally agree with you that whatever person likes to do, it's good as long as you stay active, or as you mentioned, you get sweaty from time to time. The cadence, the backgrounds of people will be different. You have a sport sort of a background when you were younger. Somebody maybe is less athletic, but still would do some lifting or jogging. So this is all great, and I think everyone could at least consider what can you do to have a longer uh, and healthy life. So your lifespan and health span would be similar, and you wouldn't just live for a long time, but being sick or not able to enjoy your day-to-day activities. Fun fact to add here, we mentioned some basketball. I know a lot of people probably have heard that, but first time I've heard that, I was kind of shocked. Let's look at the average male height in Europe. It's around 180 centimeters. So for American audience, it's like 5 feet and 11 inches, which is quite tall. Average European male worldwide, it's quite tall. I'm personally at 189 centimeters, so 6.2 feet, which is above average. It's okay. I like it. But when you look at Ben, Ben is 6 feet 11 inches, which is almost like 211 centimeters tall. Whoa, that's like super tall. I think your basketball teams benefit a lot having you on the team. Yeah.
Pretty tall. It's true.
What is like the height difference with your wife? Is she tall as well?
She's about 5'6", so she's not tall.
All right. You still managed it, so it's good.
Yeah.
Good to know. Switching to the acquisition of PWL Capital, where you work, it was recently acquired, merged with OneDigital, and this is a significant milestone. First of all, congrats. Could you please share how this transition has affected you personally, growing wealth, merging with a different org, all the challenges involved? I'm interested because my main work is business analyst, product manager in a large corporation, but I also, together with the team, have a my own product called FIRE that helps people to track their portfolios, and we also work with some personal finance advisors. We hope to scale it globally, so your insights on merging with a larger organization while maintaining your values would be valuable for sure. So, what have changed for you, and how this transition is coming to life?
Yeah, so I mean, I've been with PWL. We've so far kept our name, PWL Capital. We've been acquired by OneDigital, but we're at least for now we're keeping our branding, just because we're in Canada and they're in the US. So typically in the US they would rebrand more quickly, but it's just a little bit different because of the cross-border situation. So I've been with PWL for just under 12 years. I did have some equity. So the the transaction was okay for me personally. My role professionally has remained unchanged. I'm still the CIO of PWL Capital. Um, again, because of the cross-border situation, I think that it's a little bit of an unusual acquisition. Like in a lot of cases, you'd hear about an acquisition where a bunch of roles may be changed or get combined with roles with the acquiring company. Maybe some roles get eliminated. None of that has happened. That was actually something that was really important to us before the transaction, as a part of our due diligence. But also because of the cross-border separation, we don't have the same kind of synergies that you could find maybe in an acquisition, because all of our roles in Canada are distinct from their counterparts in the US. Like it's just a very different regulatory environment and things like that. Anyway, so all that to say, my role has not really changed. I have started getting involved with the investment team at OneDigital. OneDigital is a massive firm with a big retirement business in the United States. They've also got a pretty large wealth management business. So I've started to get involved with their investment team, which has been really interesting. Learning a lot from that involvement and hopefully contributing something as well. Uh, the question on values, like we 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 were not planning on being acquired. I think we'd grown to a point, and our brand was quite strong, and we have our content channels and things like that, which contribute to the brand. So we were just at a point where we had become a really interesting acquisition target. Apparently, we didn't go out looking for this, but we were approached in a relatively short period of time, starting a couple of years ago, by a whole bunch of different people who were interested in acquiring us to help build out their own wealth businesses through the acquisition. Now, we weren't initially planning on doing anything because it was like, oh, this is pretty cool that we're being recognized by these companies, but we've got a pretty good thing going, and it's just was not part of our plan. But as we kept talking to some of these firms, OneDigital specifically, we just saw so much values alignment between our firms, but also between us as individuals and the leadership at OneDigital that we've been talking to. So eventually, we just decided that it would make sense, which is why we did it. But if we didn't have that values alignment, I think it would be really hard to maintain your values after an acquisition like this. Like just seeing how things have worked out after the acquisition for us so far. If we didn't have that values alignment, I think it'd be really challenging. So I think that maintaining your values in an acquisition like the one that we've gone through, I think that has to happen upfront in due diligence before you decide to go through with something like that, not after the fact.
Yeah, sounds great. And as you mentioned, it wasn't your original goal, but still the stars aligned and you guys found your one another. And I hope all of that would be fruitful for your merging and acquisition activities. So congrats, and I hope to see some good new changes in the future as well for both Canadian and US based investors that want to seek some good professional financial advice. We can switch to the questions from the audience. So there are Buy Me a Coffee supporters of the Goals on Fire podcast, and they can sometimes ask questions to our cool guests like Ben today. So let's switch to those. And the first question is about the 4% rule, which we touched based a little bit before. If it doesn't really work for early retirees, what would be a recommendation instead of that? One of our supporters, Pavlo, asks, I'm broadly diversified in low-cost ETFs, contribute monthly, aim to reach financial independence in several years according to the 4% rule, but I still have some doubts from time to time. What can go wrong and how to minimize risks? That's his question.
I mean, it's a good question. The 4% rule, as it's referred to, is based on U.S. data, U.S. stock market data, and it is not designed for an early retiree. If you run the numbers in global data, which I would argue and have argued in my videos in the past, are more representative of expectations. Like if we look at the world and say what returns should we expect from stocks, I think the global stock return data are much more representative of reasonable expectations than the US historical data, because we know the US after the fact, we can look back and see that it has been a massive outlier in terms of its performance. So if you're trying to set reasonable expectations, does it make sense to look at the big outlier, or does it make sense to kind of look at the average of everything, including markets that did not work out that we talked about earlier? I would tend to think that looking at the broader average makes more sense than looking at the one massive outlier and saying, well, I want that one. Of course you want that one, but it's not a reasonable expectation. If you make a couple adjustments for global data, and you make an adjustment for the time horizon, pushing out the original 4% rule analysis was based on 30 years. If you push it out like I did, we had this question for an AMA episode for the Rash Reminder podcast that has
Mm-hmm.
not been released yet. But I did this analysis recently, so I pushed it out to 50 years, and I found a safe withdrawal rate just under 3%, which is obviously a lot lower than
I
4%.
also believe back in the day you had the video on 2.7% as the new 4% rule, but a few years ago it was also similar to under 3.
Yeah, so that was using that was a different data set. That was research from Scott Cederberg, which is probably even a little bit more pessimistic than my data. I'm using the Dimson Marsh Staunton data for my analysis. Scott Cederberg's data includes more countries that have been unsuccessful, and it goes back a little bit further in time for other countries. So yeah, it's now that's also based on Scott's research. The 2.7% was also based on a portfolio of stocks and bonds. The 3% I just quoted was using the Dimson Marsh Staunton data using a 100% stock portfolio. So the numbers can change depending on asset allocation, time horizon, which stock markets are included in the analysis. Anyway, I think somewhere around 3% is probably okay, maybe a little bit below that. So, I mean, what can go wrong? Well, you can run out of money. That's that's the main concern. That's what safe withdrawal rates are designed to prevent, is running out of money. Now, all that being said, I don't love safe withdrawal rates as a tool. I think they're really cool. Like when we talk about FIRE and thinking about that trade-off between current spending and future work, future requirement to earn money. I think safe withdrawal rates are a really cool tool to think about that kind of thing. Think about that, like what does spending now actually cost you in the future? So safe withdrawal rates are useful for that. Like how much do you need to save? How much can you spend as a very general rule of thumb? But actually following a spending rule like the 3% or 4% or whatever, regardless of what's happening in your portfolio, I don't think makes a whole lot of sense. And we did an episode on this on our podcast. I've got a video on my channel about it too. If you can adjust your spending a bit after bad years and increase it a bit after good years, you can spend a lot more overall without increasing the risk of running out of money. And in that AMA episode that I mentioned, I also talked about the the fact that safe withdrawal rates are designed to prevent you from running out of money in the worst sequence of returns. So planning your spending in the future based on historically the worst sequence of returns, I don't think makes a whole lot of sense because there's a pretty low probability that you're actually going to get that worst sequence of returns. And if you're following a fixed withdrawal rule, like the 4% rule or 3% rule or whatever, the idea is that you'll follow that rigid inflation. You're spending the same dollar amount adjusted for inflation over time, regardless of what's happening in the world. But that's okay if you want to hedge against that worst possible outcome. But if you end up getting an outcome that is not the worst historical outcome, which I think is probably more likely than actually getting the worst historical outcome, you'll end up underspending following one of these safe withdrawal rate rules. Whereas with a variable withdrawal plan, like amortization based withdrawals is one that I talked about in my video, adjusting spending over time means that if you don't get that worst possible outcome, you're going to end up being able to spend a lot more over your lifetime. So I think that's probably the biggest problem I have with the safe withdrawal rates. And it's also for people who are worried about this, I think it also gives them a lot of being flexible with spending also gives them a lot of protection, and you have to worry less about running out of money.
Yeah, I agree with you. And also, people should, first of all, watch your videos and the podcast episode whenever you guys discuss this. And also, you don't have to be, as Ben mentioned, so, fixed and rigid with, oh, it's just going to be 4%. There are different strategies like with guardrails or bucketed strategies or, cape-based strategies. There are different things. You have to explore them, of course, and probably better work with your financial advisor to understand your cash flows and additional income during retirement to model scenarios. And I also liked your more optimistic look. Let's not just focus on the worst possible case scenario. Of course, the future could be even worse than the worst available past data, but the probability probably is lower than we think. So I like that optimistic note. Let's make, sort of rational plans with positive, optimistic outlook, but without super hyped expectations.
Yeah.
Uh, Makes sense. Okay, Oksana asks, Ben, let's say you had to give up investing completely for 5 years. No investing, no advising, portfolio management, any of that stuff. What other field or pursuit would you dive into with the same intensity and curiosity you have for your current pursuits?
So, I mean, the way the question's worded, if I can't engage in investing or advising or portfolio management, which are all things that I do now, I'd probably go and do a finance PhD. Now, that might be cheating because it is very closely related to investing. If I can't do that, if I can't do a finance PhD, I would probably try and get into medical school.
Very interesting. I believe you have the engineering background,
Yeah, I
right?
did my
Uh-huh.
undergraduate degree in mechanical engineering.
Great. And you would pursue medical degree. That's very interesting.
I would
Thanks. Thanks
try. I
for
don't know if
sharing.
I can get into medical school, but that's what I would try and do it.
All right, thanks. That's quite interesting. Another listener asks, if simple portfolios work, why do we need so much research and seeking new arguments for or against this strategy or that one? From the sheer volume of the information, this person gets the impression that some people are trying to convince an average retail investor of something that is probably not very reliable. So the volume of the research is so much. So if the investing game has been solved, why do we still keep on researching and looking for other ways to improve something?
Yeah. I mean, there are a lot of different incentives in finance. Like the people doing academic finance research, they need to look for new and interesting stuff. And that can sometimes trickle down into products. And then financial product manufacturers need stuff to sell. I think simple portfolios do work, but complexity sells and complexity is profitable. Like, you can go and buy an index fund from Vanguard or BlackRock and you're going to pay them 2, 3, 4, 5 basis points. That's not great business for Vanguard and BlackRock. Um, but high yield covered call strategies that cost 65 basis points or whatever, I don't know what the fees are there, but they're a lot higher, like orders of magnitude higher. And they cater to biases that investors have. Like we talked about dividend investing earlier. Okay, well, here's a covered call strategy with a whatever 20% income yield. It's not actually income, and that's a whole other conversation. But it sells. People will buy it, and it's much more profitable for the financial companies that are selling those products. Another one is downside protection. Like there's all these buffered ETFs now that same kind of thing. They're promising upside of stocks with limited downside. That's super attractive to an investor who maybe doesn't understand the trade-offs involved with that type of product. What's other like the possibility of winning big with trading options, like multi-leg options trades that are basically like buying a lottery ticket. But people will buy them and they're super profitable for the financial institutions selling them. I think simple and boring doesn't sell in the same way. And that's why people continue to buy these products, and that's why financial companies continue to sell them. And then that research will continue because, again, like there are incentives in academia to look for interesting stuff in finance and find anomalies and find different things that could be used as investment strategies. And those incentives are not going to go away, and they're probably useful on some level. They're pushing forward our understanding of financial markets, and that's good. Financial companies are not going to stop doing research because they need products to sell. They need to innovate. There's a whole interesting question there of like, is innovation in finance a good thing for investors? And like, it's probably not in general. And then the other thing is that people like me who are giving advice to investors and helping our portfolio managers at PWL that are giving advice directly to end investors, we need to do research to evaluate whether the products that are being created are BS or not. Are the claims being made legitimate? Is this something that we should be including in our investment strategy? Now, most of the time, I think that the claims being made and the products being sold probably are BS, at least on some level. But it's important for people, for me and for people that I work with, to be able to tell people why they're BS, because they often cater directly to biases that people have. So if someone comes and says, covered calls, for example, I want to invest in this because I like the 20% yield, we need to be able to explain to them why exactly that doesn't actually make sense and it's not as good as it seems. So I guess there are a few different levels there. Like academia has its own incentives, the financial industry has its own incentives, and then someone who sits where I do, I also have incentives to research and understand those products so that I can explain them to people and help them make better decisions. But I agree with the premise of the question that a lot of the stuff that's out there is probably not helpful to retail investors. It's probably detrimental to them and is benefiting the financial companies that are selling those products to them.
Yes, I agree totally to the multi-level complexity here. And as Ben mentioned, we as DIY investors or working with financial advisors still have to filter through the noise and look for something tangible and practical. And also, as Ben mentioned, look at the incentives, what's happening there. The research that Ben and colleagues publish have totally different vector than some big company that sells you something with a high fee. So always check the background, and it's good that we have different viewpoints. We can analyze pros and cons and then make hopefully conscious decisions on this. Another question from Pavlo. It's his question. I constantly check my net worth and portfolio balances every day or so. Market fluctuations do not change anything I do with my strategy, and I follow a steady, calm growth approach, putting more money into my investments monthly. But still, I have this silly habit of checking the balance and congratulating myself on the amount invested. Did you, Ben, feel something like that in your experience, or maybe you worked with clients like that? How to get rid of this daily checks habit, in your opinion?
I have not personally experienced that for my investment portfolio, but I think this is like any bad habit. It's like spending too much time on your phone. I try and not have too much screen time on my phone, but it's hard because there are all the different things that you want to check over there. Uh, what I've done for that is deleted all of the doom scrolling apps like Twitter and LinkedIn and Reddit from my phone, and that's made it a lot easier to stop picking my phone up when I have the urge to do that because there's nothing there to look at. On investments specifically, there is evidence that people who are checking their investments more frequently perform worse. They're more risk averse, which I think makes sense if you're looking every day and seeing the fluctuations. It might make investments seem riskier. So that is a worthwhile habit to break. I don't check mine very frequently. I guess it's a little bit unique because I'm very attuned to what's happening in the markets. So I guess I have an idea of what's happening with my own investments, but I'm very rarely logging into my investment accounts to check their balances or recent performance or anything like that. But I think it's like any bad habit. You have to commit to not checking it. Make it a habit to not check. Delete the app off your phone if you have the app on your phone. Create barriers like that. I don't think you want to ignore your investments necessarily, but I don't think checking them every day or every few hours or even every month is necessary or helpful.
Thanks for that answer. And now we're moving to our final segment with the rapid fire round. Quick questions, quick answers, hopefully to get the cool wrap up for our today's conversation. So the first question is for you, Ben. What does enough mean to you, and how can others find their own sense of it?
I don't think there's any such thing as enough. I think humans are just wired for more. I've seen this many times. With real people, it's like it's just what happens. You see what other people have, and as you move up the wealth or income brackets, you start being surrounded by other people with more wealth and income, and it's just like those goalposts will not stop moving. I try to be happy with whatever I have at the time. I think it's just way too easy to let those goalposts shift. If there's an amount that is more than you have now, that is enough. I don't think that you will ever have enough.
Yeah, that's a good point. I recently read the book called Never Enough From Barista to Billionaire by Andrew Wilkinson. And among other things, it explores like how on every level of wealth, people just want a little bit more or a lot more. So it's like a good point for self-reflection when each of us, as we grow our wealth, must sort of assess objectively where have we been 5, 10 years, 15 years ago, where are we today and where we are heading next. So we shouldn't always compare ourselves to the Jonases or the neighbors. The topic of enough, I agree with you, deserves deliberate thinking and practice, and definitely, I would say, some learning by doing, because every one of us, when we were on student level, we said, oh, if only I earned this much or had this much in a portfolio, I would be set for life. But then you have kids, you have different consumption, you want to live in a different place. So it's okay. I agree with you that we have to learn to practice enjoying the abundance and great parts of our current lives as well. So let's flourish and enjoy what we have. And of course, seek something better, but not focus on that as your main life's purpose to follow some directions that will make you unhappy because enough doesn't work for most of the people. All right. Second question. How do you define success in your life? That's a question from your own podcast.
Yes, I kind of talked about this when we went through the PERMA model, but I need to enjoy how I spend my time every day. If I spend my day doing something I really dislike, that's usually not a successful day. And then I also need to be satisfied when I step back and reflect on my life, like thinking about what I've accomplished or what I'm on track to accomplish. Who have I impacted positively? The strength of my relationships with my family. So I need to be able to step back and be satisfied with all of those things. So the two things: enjoy my time throughout the day most of the time, and then be able to step back and be satisfied with where my life is. I think those two are important because you could sit in a hot tub drinking beer every day and be like really happy with how you spent your day. But then you'd look back in 10 years and be like, wow, what have I accomplished? Nothing.
Yeah, it's a very important and great point to be in the moment, but also have some reflection over the past and what you want to achieve in the future. So thanks for the answer. I think it's a great framework for anyone to adopt or at least consider in their own life. The third question is, Ben, can you please name three good books you would recommend to our audience? They may be finance related or maybe not. What would those be?
Three books that I really enjoyed are Technological Revolutions and Financial Capital by Carlota Perez. That really changed my mental model for the relationship between, well, technological revolutions and their relationship with financial capital and the expected returns of investments. I've done content on this, but basically, the expected returns of investing in technological revolutions are really quite unattractive. And Perez's model kind of goes through that and explains why and relates it back to history. The Great Depression, a Diary by Benjamin Roth is another one. That is a firsthand account of someone who lived through the Great Depression and the stock market crash of 1929 and all that stuff. And it's incredible to read a firsthand account of someone who was a business person. He was a lawyer, and he's living and working through that period and talking about the bank closures and the lines for the bread lines for food and like all that kind of stuff. But just from a very sober perspective on this is what is happening. The big thing I took away from that book is that like life goes on. Like that was not a fun time, but life went on, and people were ultimately people got through it. They found ways to get through it. And then the third one I would say is the Happiness Hypothesis by Jonathan Haidt. It's a bit of an older book. Well, it's not super old, but there have been many more books and much more research on happiness since that book came out. But I think it still holds up really well. And it was the first book that I read that really kind of opened my eyes to the relationship between money and happiness, and just what predicts happiness more generally. So those three I think are all books that kind of change my perspective on things that matter.
Thanks. We tried to share the books on this channel as well. I know you guys in Rational Reminder had a book challenge type of thing where you try to encourage people to read more. I think books are like good, dense ways to explore some ideas that somebody spent a whole lifetime researching. You can have it in like 8 to 10 hours and sort of get the best of it. So thanks for sharing. Definitely. You should check out those books, the listeners of the show. And the final question on the time travel. If Ben, you could share a brief piece of advice with your 20-year-old self about investing or life, what would that be?
I mean, this is a funny question, right? Because if I could literally time travel, I would probably go and find the whatever asset that had the highest returns over that period of time, and I'd be like, listen, borrow as much money as you can and buy that. But I don't think that's what you're actually trying to ask me. I don't know. I'm a little bit stubborn, admittedly, and I think especially in my 20s, like I feel sorry for my parents if when they were trying to coach me in different directions. I had to learn things myself. I think if current me appeared to 20-year-old me, 20-year-old me probably wouldn't listen to any advice that I gave myself. So, but he'll figure it out though. So I'm not going to say anything to him. He's going to figure it out. 20-year-old self will figure it out.
Yeah, that's a good answer and good confidence in your younger version of self, which is good. We all been through different ages. All right. Thanks, Ben. Maybe any final thoughts for those striving toward mindful investing and meaningful life?
No, I think we covered a lot of ground. Seems like you're doing a great job with this podcast, and your listeners are very fortunate to have a resource like this to help them make better decisions.
Thank you a lot. Thanks for joining me for this conversation. Please, whoever is listening to us, leave us comments, leave us reviews, tell us what you think. What was interesting? Did you find out something new about Ben and his approach to life and investing? As always, huge thanks to everyone who supports the show. All the comments are welcome. Of course, go and follow Rational Reminder, Ben's channel, if you hadn't already done that. Thank you again, Ben. Thanks for everything you do for the global community of mindful, savvy investors who like to make better decisions on daily basis. And I wish you a good luck, and hopefully our paths would cross in the future as well.
Awesome. Thanks.